go-to channel for smart, future-proof investing strategies. In today's video, we're diving into something that's turning the heads of both seasoned investors and beginners alike: the 120-year investing rule. If you've heard of 100 minus your age or 110 minus your age, get ready, because the 120-year rule might just help you retire like a king and leave a legacy like an emperor. Why the 120-year rule? Traditionally, you might have heard about the 100 minus your age rule for asset allocation, meaning if you're 30, you hold 70% in stocks and 30% in bonds. But people are living longer now. That's where the 120-year rule comes in. 120 minus your age equals percentage in stocks. Example, if you're 25, the rule says 120 minus 25 equals 95% in stocks and 5% in bonds or safer assets. This might sound super aggressive, but with people living into their 80s, 90s, or even beyond 100, having more growth potential in your portfolio can be a game changer. The normal investing approach versus the 120-year rule case study: 25 years old, monthly 20,000 rupee investment. Let's break down a simple scenario. Imagine you're 25 and can invest 20,000 rupees per month until retirement. Normal approach, 100 minus age. At 25, you'd hold 75% stocks and 25% bonds. Assume an average annual return of approximately 10% for stocks and approximately 5% for bonds. Over 35 years and investing until 60, you'll rebalance from 75% stocks and 25% bonds to about 40% stocks and 60% bonds near retirement. The estimated corpus at 60 might be around 10 to 11 crore rupees. Note, depending on market fluctuations, 120-year rule approach: at 25, you'd hold 95% stocks and 5% bonds. You'd still rebalance, but you'll remain more stock heavy. Estimated corpus at 60 might be around 12 to 14 crore rupees depending on market conditions. That extra potential growth can help you leave a legacy like an emperor, whether that's generational wealth, charitable giving, or simply a more comfortable retirement. Important note: this is a simplified example to illustrate the difference in growth potential. Actual results will vary based on real market returns and how consistently you invest. In-depth benefits and considerations, pros and cons. So why would you go with the 120-year rule? Pros: longer horizon. If you plan to live into your 80s or 90s, you need higher growth to outpace inflation. Higher returns. A larger stock allocation often means higher returns over decades. Legacy building. More growth potential for passing wealth to your kids or philanthropic causes. Cons: volatility. Bigger swings in your portfolio. You need a strong stomach for market downturns. Rebalancing: complexity. Managing a stock-heavy portfolio requires discipline to rebalance, ideally once or twice a year. Risk tolerance. Not everyone can handle a 95% equity position at 25, especially if job security is shaky or personal finances are unstable. How to implement the 120-year rule. Assess your risk tolerance. Are you comfortable with market drops of 30 to 50%? If not, consider a peak. 115-year or 110-year rule. Pick a diversified equity portfolio. Consider index funds like UTI Nifty Next 50 Index Fund or DSP Nifty Next 50 Index Fund, where you can start investing as low as 100 rupees only. Add some international exposure if it aligns with your goals. Keep a bond or safe asset slice. Start at around 5% to 10% in your 20s and gradually increase over time. High-quality bonds or even T-bills can serve as your safety net. Automate and rebalance. Automate that 20,000 rupees monthly investment. Rebalance at least once a year to maintain your target ratio. Monitor and adjust life changes. Marriage, kids, job shifts might alter your risk profile. Adjust your ratio accordingly. Real talk. Who is the 120-year rule for? If you're 25, have a stable job and a high risk tolerance, the 120-year rule might be your ticket to outsized returns. But if you're older or extremely risk-averse, maybe 120 is too high. You could do 115 minus your age, or even 110 minus your age. The key is to match your risk tolerance and your financial goals. Retire like a king, leave a legacy like an emperor. All right, folks, that's the 120-year rule in a nutshell. It's about embracing a more stock-heavy portfolio because we're living longer and need more growth to outpace inflation and secure not just a comfortable retirement, but a lasting legacy. If you found this video helpful, smash that like button, subscribe to Investor Owl for more deep dives into personal finance, investing, and wealth building tips. And drop a comment. Would you try the 120-year rule? Why or why not? Let's discuss it. Until next time, I'm Prasenjit, and this is Investor Owl, where we help you invest smartly so you can retire like a king and leave a legacy like an emperor. Thanks for watching.